Hey, welcome back, options traders. Well, in markets like these, and I'm talking about mid to late September of 2022, when you get lots of uncertainty, lots of volatility, lots of different topics, whether it's Ukraine or inflation or China. And when that happens, you can get some very big option premiums for these out-of-the-money options. And a lot of times new traders think, hey, this looks like free money because all I have to do is sell a far out-of-the-money option. And instead of getting the usual 5 or 10 cents because they're so far out of the money, now I can get 50 or 75 cents. And I'll put this on 10 or 20 times and it just looks like free money. And that's true, it does look that way, but there's something that you're overlooking, and that is tail risk. So what is it and why is it such a danger? Well, let's go have a look. And as always, before we do, please be sure to click like and subscribe. It goes a long way into supporting the channel and is very much appreciated. So let's take a look at the returns of the S&P 500 index over the last, I think this is about the last 75 years or so. But the point is that you get this very tall, skinny type of a bell curve. But if we were to actually overlay a bell curve on it, you would see that it doesn't quite fit. The center, these blue bars of the histogram, sit up a lot higher than would be projected by a bell curve. That just means there's more probability for the prices to stay in the center than would be predicted by the bell curve. But we can also see that there's this white area right here. I'm going to shade it in red. So that's some area that's missing. It's not quite as likely as we start moving out to the wings. So where did all that probability go? Look way out here. It's hard to see, but there's some little blue bars right out here. We'll look over here to the right. Look how far out these are. These are several standard deviations up or down. So the bell curve would say that this is about the limit to the high side in this area. This would be about the limit to the low side, but that's not true in the real world. And this is the tail risk. You're selling options that are based on probabilities out here, but you're really subjected to probabilities out here. Now, there's a whole separate argument that's called a well-behaved bell curve versus a not so well-behaved bell curve or a distribution. So for example, let's go take a look at Gilead Sciences. And here we're looking at 1 year's worth of returns. These are daily returns. How much percentage up or down was the stock? So at this time, take a look at plus and minus 3 standard deviations. Pretty remarkable for a stock that's usually considered to be super volatile. That's the way that most traders would think about biotech stocks. But look at the number of times that it touched up here at 3 standard deviations. That's just about what you would expect according to a bell curve. So this is what we call a well-behaved bell curve. Even though it might have a lot of volatility, it's fairly predictable because it kind of obeys these boundaries within a bell curve. So if we were to look at this same information on a histogram, this is what it looks like. Again, conforms pretty much to a bell curve. But now let's go take a look at Ford. Most people would think that Ford isn't real volatile, but let's look at it on a daily volatility. And if we do, look at this. Here's plus and minus 3 standard deviations. See, this is not so well behaved. Look at these spikes. This one right in here is starting to touch up towards 6 standard deviations. You would expect that to occur about once every 1.4 million years according to a bell curve. Check these out here, starting to push 8 standard deviations and 8 standard deviations to the high side. Those you could expect about once every billion years. And yet we got 2 of those in the same year, and we got 1 at 6 standard deviations. So this is the histogram for that previous data, and look at these tails way out here to the left. See, this is something that a bell curve would really never predict. And so when you're selling those options, you are receiving premiums based on maybe this level to the downside or maybe this level to the upside. But look at what you're actually exposed to. And as I've talked about in previous videos about normalized vega, that's a whole separate conversation that just compounds this risk. But the thing that you have to be aware of is the idea of tail risk. And what that really means is that the tails of this bell curve, the far left and right sides, are far more likely to occur than would be predicted by a bell curve. And when you're looking at things like delta and probabilities of expiring in the money and other things that your platforms can give you, it is always assuming a Black-Scholes model. So it's going to be looking at this distribution here in the center, more of a bell curve, as opposed to what we typically get in the actual markets. Now these are, by the way, what's called a leptokurtic curve. How's that for a word? And really what it means is that we have a taller, skinnier center than would be predicted by a bell curve, but we've got fatter tails. See, these tails sit way out here. That no bell curve would ever expect these to occur, but in the financial markets they do. And this is the key point that you must be aware of before you start writing out of the money options. Now also, even if they're not out of the money, sometimes people will enter into a vertical spread and they will sell off this tail, but they might sell it for 5 cents or 10 cents. And sometimes you have to step back and say, if you're in a real volatile market, is it really worth giving up these tails for such a small amount? So it doesn't just apply to naked options. Anytime you are selling an option, you have to understand that you are cutting off these tails. And those are potentially very big sources of rewards. And so make sure that you are being adequately compensated before you sell them off. So as a recap, tail risk, really what it is, it's the risk of an unexpected move much larger than predicted by the bell curve. Remember that stock prices are log normally distributed, and that's really what helps to create this leptokurtic curve. And so what happens is we end up with far more probability for moves outside of 3 standard deviations than would be predicted by a bell curve. And that is tail risk, and that's why you have to be very careful about how you hedge, roll, and morph. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.